Hello, once again. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region, here to give you my professional and honest opinion regarding the 2022 Canadian housing market. Today, I'm going to talk about the dead cat bounce and the scary link between our variable rate mortgage situation in Canada and the subprime mortgage crisis in the States in 2008. So first of all, let's get into the dead cat bounce. First off, here's an infographic from Warrior Trading, and it just kind of shows you what the dead cat bounce is there. It is, of course, when things skyrocket to a peak, they drop, and of course they do a bounce before they continue to drop, sometimes called a bull trap. And the definition there is at the bottom. In trading, dead cat bounce refers to a temporary recovery that happens after a long decline, which is usually followed by a downtrend. It can be defined as a chart phenomenon that happens during bearish moves. And another infographic that I've shared before, but let's look at it again. This is the stages of an asset bubble, just general asset bubbles with stocks and whatnot. And you can see the stages, of course, on the way up: enthusiasm, greed, delusion, new paradigm, which we reached in February, denial when things start to drop, and that bull trap or dead cat bounce, as I said before, and the return to normal. And of course, now we have this return to normal. We're in this return to normal stage, and you hear it from certain sources, certain realtors. Hey, looks like the worst is over. Prices have leveled off and sales have kind of started to pick back up. Well, that was for October. Some certain narratives were saying. And of course, after the return to normal comes the fear, capitulation, and the rest, despair. I don't know if we'll reach despair, but anyway. And I do suggest you do your own research with stages of asset bubbles, because you'll see a normal trend. Here's another one from the Motley Fool, stages of a stock market bubble. And they're all very similar, the actual chart part of it, but the boom, euphoria, peak, and collapse. And here's yet another one from Time, I think magazine. I don't know who it's from, but it says at the bottom, Wall Street cheat sheet. And of course, it's a very similar trend. So this is not a new phenomenon. It's a very common phenomenon. And I want to see how it applies to real estate. So, of course, I've done this months ago on this channel. So here's my updated real estate stages of the asset bubble. And this is using the Ontario data from ITSO. Again, I talk about it all the time. This is pretty much everywhere surrounding Ontario. 20 boards are involved, lots of listings. And this goes back 5 years. Of course, it goes from first sell-off, media attention, enthusiasm, greed, delusion, new paradigm, denial. Of course, the bull trap or the dead cat bounce, return to normal. And that, like I've said before, we've heard many people, agents, and professionals talking about it looks like the worst is over. We're going to return to normal. Things are leveled off, and next year is going to be great. I don't know if they say it's going to be great, but I get this feeling that they think the worst is over. But of course, in that stages of asset bubbles, that's just a minor uptrend. And we still have the fear and capitulation to get into. And I also applied this to the national house price. The red line there is the actual average price, not the index, even though you could probably use the index too. But the index won't really show the immediate bounce. But yeah, you can see we had a national bull trap or dead cat bounce there too. And through the denial, sorry, I spent denial wrong there, but typo in my part. But you can see, yeah, we've hit that bull trap, and yeah, we'll see where it goes from here. But given historical charts and trends, I think it's going to go one way, especially with interest rates and all the rest of that, and unemployment, which seems to be starting to rise, but we'll keep an eye on it. So yeah, lately I've been noticing a comparison between certain aspects of the 2008 financial crisis or the subprime mortgage lending crisis. Now, there are, some major differences, but I wanted to go through the similarities too, just to show you that it's pretty scary that we do have some very common themes here. So let's just give a quick recap of what happened with the '08 subprime, lending crisis. So I got some information here from fool.com. It seems to be Fool, Motley Fool, all these things. But this is just a beginner's guide, right, to the 2008 subprime lending crisis or mortgage crisis. A timeline of events. The cause of the crisis was years in the making and didn't happen overnight. Of course, yeah, it didn't happen overnight. And it's, again, we've been 8 months, and this is what I try to tell people. You don't crash and recover in 8 months in real cycles, right? In manipulated ones where they raise interest rates temporarily and drop them right back down, sure, but this is not a temporary interest rate hike. 2000 to 2003, interest rates during this time period were lowered from 6.5 to 1% due to the dot-com bubble and September 11th, 2001 terrorist attacks. Low interest rates provided cheap credit, and more people borrowed money to purchase homes. This demand helped lead to the increase in housing prices. So again, Canada, same thing, and in the States too, the same thing this time. We've had, excuses to keep rates low. First, it was just slow economic times before the pandemic, and then of course the pandemic. So there's our trigger, our excuse to drop rates, keep them low, right? So this is what happens. From 2004 to 2006, interest rates went from 1% to 5.25%. This slowed demand for new houses. Many subprime mortgage borrowers who were unable to afford a conventional 30-year mortgage took interest-only or adjustable rate mortgages that had lower monthly payments. So it's a very similar situation to Canada these days, or just months ago, where people would opt for that variable rate, 1%, 1.5%, low interest, low payments, to be able to afford a house, right? The interest rate hikes increased the monthly payments on subprime loans, and many homeowners were unable to afford their payments. They were also unable to refinance or sell their homes due to the real estate market slowing down. The only option was for homeowners to default on their loans. Home prices fell for the first time in 11 years in the fall of 2006. Of course, they couldn't afford the payments once the interest rates went up. So there was many things that caused the subprime mortgage crisis, and there was many effects after. A lot of it was to do with the mortgage-backed securities later on, but we're just going to talk about the situation with the homeowners and the defaults. So of course, mortgage lenders were a big part of that problem. They were greedy and handed out interest-only and adjustable rate mortgages that borrowers were not able to repay. In other cases, some mortgage lenders even committed mortgage fraud by inflating borrowers' incomes so they'd qualify for a mortgage. So we're seeing many similarities to what's happening in Canada, right? Pushing these interest-only or variable rate mortgages, and even some mortgage fraud, as we've seen in the news lately. People borrowed to buy houses even if they couldn't really afford them. While there were some buyers subject to predatory lending practices, many took on too much risk and bought houses they could not have or should not have. After the Fed raised interest rates, home buyers were unable to afford their mortgage payments. So it's pretty scary when you compare the two. And I just want to give a summary here of what's happened then and the similarities to what's happening now. So super low rates provided cheap credit for people to buy homes. Of course, we saw that in 08 or before 08 leading up to the crisis, and now in Canada. And of course, home prices increased due to higher demand. So prior to 2008, many people in the States took interest only or variable rate low interest mortgages so they could afford homes. Just like in Canada now, with home prices that were so elevated, many of the buyers took these variable rate mortgages. Yes, they were still approved at a higher rate, but they did it for affordability. And of course, who knows what happened after they get in? Maybe they go buy a new car, take on more credit. But very similar to what happened in the States. As interest rates increase, many homeowners couldn't afford their homes back then. They go to sell them, they couldn't sell them because the prices have dropped. They try to refinance them, they couldn't refinance them either because they're worth less than they paid, or they're worth less than the bank was willing to give them. And of course, the big one was some mortgage brokers committed fraud by inflating borrowers' incomes so they would qualify, which again came back to bite them in the ass later when prices dropped and interest rates increased. So in Canada, as opposed to the States, we're not giving out loans to subprime loans to people who shouldn't have them. We stress test our buyers so that when rates do go up and have gone up, they technically can't afford them. At the same time, I don't think they've included high inflation into those stress test equations. So that's going to be an issue right there. And I don't know if they calculated in their stress test equations or calculations that our interest rates would be surpassing those stress test requirements. So many of our interest rates, or a lot of them now, depending on when you got the mortgage, have surpassed it. So of course, it comes back to this trigger rate issue. Now with the trigger rates, the homeowner has three options. The first option is to increase their monthly payment, which of course they're stress tested, so it shouldn't be a problem, which I think would probably be the best option so that, you're affording it, you're not kicking the can down the road, you're staying on top of, interest rate or extra interest charges. The second option is to make a lump sum payment so that you're not getting too far behind in negative equity or negative amortization. And the third option is for the bank, I guess it's the bank's decision, is to negatively amortize your mortgage payment so that you're adding time and potentially money, well, you're adding money onto the end of the payment. So you might go from a 25-year mortgage, pay off a couple of years, but you're back to a 25-year mortgage because your payment hasn't changed and you've been barely covering the interest or haven't been covering the interest, and they're adding it back onto the end. That is the worst option, in my opinion, because it comes back to kicking that can down the road. And when in a year or two from now, it's going to catch up. Let me know your thoughts on it. But again, my thoughts are what just happened in Canada with these low interest payment loans that are going to catch up to people with slowing real estate markets and lower real estate prices. They're going to be in a situation where they can't afford the payment potentially, and they can't sell the house or refinance the house because it's worth less than the bank says, or they're going to be, $100,000 in the hole. So I think it's very similar fundamentals behind what's happening now compared to the States. And of course, will that affect the bank's business, right? Will their mortgage-backed securities or bonds and get affected or be worthless in the future when they have this book of business on these prices that are, $500,000 homes and they're worth 400, or $1 million homes and they're worth 800, and the consumers or the homeowners have paid nothing, or half of the book has paid nothing. So I think it's again, it's a very serious situation that is going to affect us in the future. And if things keep going the way they're going, it's going to get pretty bad. So before I go, I just want to read, or I'm not going to read because then I have to quote and put his information in the comments, which I don't want to do. I don't like bringing up people's names, but I got this flyer in my mailbox from one of the local realtors that's, a big shot realtor. And of course, they admit now that, okay, prices have slowed and sales have slowed and all the rest of it. And of course, interest rates are up. Now they're saying, well, this is more normal, so be prepared. This is normal. This is not abnormal. These are not high rates, which good point. But at the same time, like maybe you should buy now is what the pitch is. And again, I'm not going to quote word for word, so I don't have to quote him or cite him in the comments and rat him out because I don't like, again, bringing names. So what he says at the bottom, the sales pitch in this flyer is, it's not all doom and gloom. Over the long term, prices will always rise. So what you should do is whatever your house is worth today, just double it. And in 10 years, that's what your house value will be. So I was just like, wow, that's like a huge statement. Like my theory would be whatever your house is worth today, it might be worth the same in 10 or 15 years as it is today after we go through this big, economic slump and crisis and recession, whatever's coming. But, this look is the complete opposite. But there's no data to back this up, where I like to give some data or some historical trends to kind of show this is why I'm saying this, instead of just, this is my opinion, trust me, I'm a realtor, buy a house or sell a house, whatever the deal is. So again, think about what your house is worth, and very simple, just double it. And that's what it'll be worth in 10 years. So again, I think it's pretty reckless to say something like that. I know historically prices go up over time, but sometimes they don't go up for 10, 15 years. So is it going to be worth double in 10 years? Should you base your financial decisions on your house being worth double, knowing that it's going to go down in the short term? So anyway, let me know what you think in the comments. Next week, I'm going to have the stats from across all of Canada. Be interesting to see how November did. I think we're going to see some slight declines, but we'll see then. Until next week, I'll see you then.